SPACs, memes, NFTs, Dogecoins, some of these words didn't even exist a few years ago, but now everybody seems to be talking about them. In the past year, an explosion of alternative investment vehicles have caught the eyes of a new generation of retail investors. How they trade, invest, and share information has shaken up the way we look at markets and the markets themselves. And now, with a look at the long-term implications of this retail revolution, is CNBC's Melissa Lee, joined by three industry leaders: New York Stock Exchange President Stacey Cunningham, former SEC Chairman Jay Clayton, and BNY Mellon Wealth Management CEO Keating. Melissa, the stage is yours.
All right. Thank you so much, Tyler. Let's talk about memes. AMC and Reddit, a sentence I never thought I would utter a year ago. Catherine, I want to start with you because certainly what we've seen in the past 6 months, 7 months, 8 months is the power of this new group of investors. And I don't want to characterize them as younger investors, although they tend to be younger or unsophisticated because they have proven to be sophisticated in terms of their knowledge of the market. Do you think that this shift that we've seen, is this a permanent change in the markets that we are witnessing?
It is a permanent change, and I think it's important to step back and say, why is this the case? I would actually call it a new generation of investors. And the reason that we have this rising group of individual investors is that the retail market in this country has become larger than institutional, and it's growing faster. And that's something I might not have contemplated at the beginning of my career. But what's caused it over the last decade or so is really a fundamental change in how we save for retirement in this country. If we think about our parents' generation, they probably worked for a single company for a long time and graduated with a pension that paid them for the rest of their lives, and if they were lucky, the rest of their spouses' lives. That's really not the case anymore for most of us. Most of us are now saving on our own in 401k plans and with our own private savings for our retirement. And so this is a permanent phenomenon. The retail investor is going to be very important to the market, but the market is also very important to the retail investor because most of us are saving for our own retirements and our own financial future.
A lot of people, Jay, will make the comparison of this group of investors and what they've done with stocks like a GameStop or an AMC and what went on in the internet bubble when retail investors drove that bubble. And I'm wondering if you see similarities or are there really differences in terms of how this new cohort is getting information, how they are engaging with the markets, their knowledge of the markets, and the tools, the technology available to them?
Well, let's separate this into two things. We do see what we're calling the meme stocks and what I would say is the euphoric activity, the non-fundamental activity around the meme stocks. That's something regulators and we all need to be cognizant of. But to Catherine's point, if across the spectrum of our society, more people, we have 50 million homes, let's try to get that to 75 million homes, are participating in the markets earlier and understand how important it is to their future to invest early, that's a terrific thing. So, we do need to look at what's going on with the meme stocks, the volatility, the departure from fundamentals. But if a byproduct of this, or even better than a byproduct, a significant result of this is earlier education, earlier investing, and broader participation, Melissa, it's needed, and the demographics here are clear. When I was just getting going, your life expectancy after age 65 was 12 years. It's now 18 years if you live to 65. That's another third or a half, depending on how you do your math. These things are really important.
Stacey, do you think corporations are prepared for this fundamental change? I mean, if you take a look, for instance, at how AMC's shareholder base has changed so profoundly in just the past few months to predominantly a retail shareholder base, 80% of its float is held by the retail investor. Are companies ready for this sort of engagement, maybe going to YouTube instead of having an investor call or an analyst day, for instance?
I think it's a great question, Melissa. And as companies continue to evolve and the landscape evolves around them, the investor base, the retail investors are a big changing profile within that. They're also being asked to change around how they communicate on issues when they think about their stakeholders more broadly. And so their communities are a big part of that. And so companies are really taking a step back and thinking about, are they communicating the right messages out to the world, and communicating to their investor base, which is changing, is going to be part of that as well. And it's certainly an area of focus. We've already seen companies thinking about opening up opportunities to retail investors, especially those that have a consumer-based product. And Spotify, one of the reasons why they chose to do a direct listing and really innovate on that front was because they wanted their customers to have a democratized access to their listing day. And so I think there are companies who are leading on that charge, recognizing that the retail investor is a really powerful target investor base. And then there are others who are trying to figure it out along the way right now.
Yeah. Jay, you're trying to make the point of separating sort of the different types of retail investors, and I completely get that point. But if you take a look at this new sort of generation that's coming to the market, which is a good thing, it's always good when people are engaged in investing in the stock market, they have a deep mistrust of regulators. They feel the SEC is not doing anything to protect them. And whether or not that is true or not true, it is the perception. Should regulators be more forthcoming in engaging this new investor class, seeing that they are here, they are paying attention, they are having an impact on the markets, and they are extremely distrustful, specifically of the SEC?
Well, look, it is a good question, Melissa. And what is the job of the SEC? And I think we need to have a dialogue with this retail investor community around exactly what the job of the SEC is. And that is, with respect to companies, let's just talk about companies communicating with the market, as Stacey mentioned, it's to regulate the dissemination of information. That information has to be fair, it has to be complete, it can't be false or misleading. The SEC's job is not to regulate prices. Prices are discovered in the marketplace where buyers and sellers meet. Now, the SEC does have a role if people attempt to manipulate prices. Pump and dump schemes and the like, and the SEC should be very vigilant there. But the SEC's job, and it really can't be, because how do you choose when to step in on pricing, is not to regulate prices. Now, we do have circuit breakers and the like for people to take a pause and digest information, but our market regulation is really based on information access, and if that information is false or misleading, that investors have an action to bring, or the SEC brings action.
So then to that point, Jay, just to follow up, I mean, if you take a look at the price action of, let's say, a GameStop or an AMC, which can rise in a single day by 100%, doesn't that seem, on the surface at least, an issue that the SEC should be very attuned to, and wonder, why is it that these stocks have such wild swings in the market?
We are seeing flows, and Stacey knows this very well. We're seeing trading flows from retail investors that, I'll use the word, are unprecedented. And that is what is going on. That is what is driving these price swings. Again, in America, we don't tell people you can't buy and sell securities unless there's an information problem or there's a manipulation problem. And what we are saying, let me say one area where I do get concerned, and it goes back to companies, is slivers of information that retail investors are buying or selling on, they're trading on. When companies endorse those, I think companies should be careful about that, because companies know that their value isn't based on one piece of information, but it's based on an overall mosaic of information. And that is an area where the SEC needs to be vigilant, and companies themselves need to be vigilant.
Melissa, can I just jump
Catherine,
in there for a
what's your
second?
take on? Oh, yes, of course, Stacey. Go ahead.
Sure, because I think a couple of the things that Jay said are so important. I mean, that information, it's really critical that we provide opportunity to access opportunities for investors. And I would argue that it wasn't just the SEC where the retail investor is frustrated. I think they feel like the system is rigged against them on a number of fronts. And so whether they are blaming hedge funds or other elements, and so we want to make sure that that access is open to them, and that they have the information to make informed decisions, but that we don't close off the access by putting in regulations that deny them those opportunities entirely.
So to that point, Stacey, can we get to one issue that seems to be a popular one, amongst these new retail investors, and that is where trading happens in terms of how much is going on public exchanges like yours versus how much goes on off exchange through wholesalers or in the dark pool. According to the SEC, the latest figures that I have, 53% of total trading on any given day happens on public exchanges in the U.S., 38% off exchange through wholesalers, 9% in dark pools. There is a perception that the information gleaned from dark pools by players like a Citadel or a Virtu gives them an upper hand in terms of pricing to the disadvantage of the retail investor. Can you address that?
I think one thing to recognize, even those stats that you're showing, in single stocks, those stats are even more significant. So in some of the meme stocks that we've seen, or where there are stocks that have high-level retail participation, the vast majority of order flow can trade off of exchanges, which is problematic for a number of reasons, not just because of information disparities, but also because that price formation is not really reflective of what supply and demand is. And that's what our markets are intended to do, is really find price by contributing all of the interest across all investors. And when you're not including sometimes 65% or 70% of investors, you're not really getting to what that price is. And so we do think that the pendulum has swung too far, and that some of the policy decisions that the SEC made to promote competition at an order level have actually led to a lot of fragmentation and off-exchange trading. And we would be encouraged to see more transparency into that price formation. So I do think that while retail investors have a good experience in many ways, that ultimate price, the best price in the market, should be set in a more transparent way.
Catherine, what's your take on all of this? Because the notion is that the more it happens off exchange and through dark pools, the less reality there is to the stock prices that the average person sees, rolling across the screen on CNBC, that doesn't reflect the actual market, since so much volume is taking place off that market.
So look, I would step back and say, when we think of the retail investor, we think of their investment activity really in three ways. The first is, saving for retirement, the $7 trillion defined contribution market and personal savings that people have. The second is trading, what we're talking about today. And we know that the retail investor, the impact on trading in the market has grown over the last year from anywhere from 20% or so to 35%. We also know that the retail investor tends to be very price sensitive, much more price sensitive than an institution. When the market goes up, an institutional investor looks at their asset allocation and their policy statement and tends to rebalance to keep their equity holdings in line with their long-term goals. That doesn't necessarily happen with the retail investor and trader. And in fact, we see, it doesn't happen. And then the third thing that we think about is actually speculation, because of course you can buy directly, but you can also buy on margin. And as we think about market cycles maturing, one of the danger signals we always look for is, do you have margin debt growing at faster than the economy or faster than market capitalization? And we don't see that today. But what we do see is a lot of speculation in the retail market in some of these meme stocks. So for example, you can look at a couple of those names, and while the retail investor might have a relatively modest share of the trading, they could have 80 or 90% of the option trading, right? So leverage trading. So we look very carefully at that because all three of these things matter to the market.
Catherine, do you feel like retail investors are accepting a new level of risk that didn't exist before? I mean, are people's attitudes towards risk-taking in their accounts, has that changed as we are seeing the rise of a meme stock or the rise of Dogecoin, et cetera?
Yeah, so I would say that we've seen that change both in long-term investing and in trading. So in long-term investing, we know what happened last year. We had the steepest market decline and the most rapid recovery. April of last year was the strongest month for the S&P and in my career, up over 12% in a single month. And so we can watch investment behavior by retail investors by looking at what they buy, right? And so institutional investors were rebalancing when the market went down so that they could get the power of that fast rebound. And yet we saw mutual fund flows and ETF flows all through the course of last year really going to fixed income and cash. And so we saw that retail investor actually not participating in the rebound until earlier this year when they started to come back with fund flows. So that's what we saw from an investment perspective. From a trading perspective, we've seen the share of the retail investor, their share of trading, rise as a percentage of overall trading since the pandemic started, right? So before the pandemic, it might have been about 20%. Now it's 35%. And we do see, as I said before, some speculation going on with that. Obviously, we've been talking about the meme stocks. They've had the biggest impact on stock prices in the small cap space, where you've had high short interest. But the truth is they bid some of those stocks up to be mid-cap stocks or even larger. So, for those of us that own index funds today, we actually own some of those meme stocks right now, and we're relying on our index fund provider to help us manage it.
Yeah, that's a good point there. I want to get to some questions because we're getting a lot of good ones here. Frank asks, and I think this one will be directed to Jay, shouldn't the SEC and regulators focus on the fraud in the market versus some message boards on Reddit? I think that's an interesting question because, the message board, the Wall Street Bets board, that has been, the touchstone for this new generation of retail investor. And some might even say that there could be fraud on these message boards as well. What do you think, Jay?
Well, let's talk about that because we should level set the retail investor. The responsibility that companies have to provide information and the liability that they take on in being public companies is very significant. Companies have controls in place, all sorts of checks and balances to make sure that the information that they're providing to the public is fair, accurate, and complete. And retail investors should understand that. The responsibilities of market participants who are not connected to companies and who are not brokers who have a best interest obligation or investment advisors who have a fiduciary obligation. The responsibilities of people on the message boards are much less. And you know what? The simple truth is they should be given less deference as a result, less credibility. You should understand this. Now, that said, to the extent there is fraud going on, the extent that people on these boards are saying, X is true, let's run up the stock. Should we be looking into that? Yes. But also people have to recognize that the responsibility at the law that those individuals have is so much less than companies and professionals. And they ought to be looking to the companies and the professionals much more so than what's going on to use the word, unregulated message board.
That's understood, Jay, but you're talking about a generation investor that largely doesn't trust the investment professional, and which is why they're going self-directed, why they're going straight to Robinhood. They don't want to pick up the phone and call a broker or a financial advisor. That is, not in their heads. And so when they turn to a message board or they turn to Instagram, and we just ran a story on CNBC.com saying Kim Kardashian is promoting crypto and she's getting paid for it. And granted, there's a little sign on the bottom that says ad. But you've got influencers out there that are capturing the attention. Should the SEC be more in tune with this and create some regulation surrounding the impact of these influencers in the market?
No, and to be clear, Melissa, I don't think the SEC should ignore this. I do think the SEC should be looking at this in the message boards. And is it analogous or similar to what you would have seen in your traditional pump and dump type activity in the penny stock arena? Of course they should be looking at it. But we also do need for people to recognize that, take a moment and ask, is this a reliable source of information about the company? Okay, I mean, I get it that people may not feel like companies are as forthcoming as they would hope or whatnot, but recognize the companies do have legal responsibilities. The SEC is watching them closely. They have auditors. Their financial statements have to be audited and prepared and distributed. I do think we have a situation here where things are a bit askew in terms of where you're getting your information.
Okay. A terrific conversation. I'm sure we'll be talking about meme stocks for a while now. Thanks for joining us today, Stacey, Catherine, and Jay. Appreciate it.